We just finished going through Samsung's FY2026 Q2 earnings call materials, and now we want to sit down and share our takeaways with you. Let me start with one number, 52%. That's the operating margin the company reported this quarter, and for a memory maker, that is flat out staggering. But hold on, don't pop the champagne yet. Because underneath that gorgeous headline, there are two Samsungs living in the same building, and one of them is quietly bleeding out. Let me walk you through it step by step, the way I'd want somebody to explain it to me. Here's the data the company put on the table. Revenue came in at KRW 1.5 trillion, up 28% quarter on quarter. Operating profit, 89.5 trillion, up 56%. Do the math yourself. Profit grew twice as fast as revenue. That's what operating leverage looks like when memory prices are running hot. The company stated both DRAM and NAND hit record high volume shipments this quarter. But here's the part I really want you to hear. Management says the real story isn't the record, it's the architecture of the revenue. Their words, they are engineering a transition, turning memory from a boom and bust commodity into a high visibility business locked to 2028, our take. That's the whole ball game. Anybody can string together one great quarter. The question that decides this stock is whether they can make it durable. And that's what the rest of this deck is trying to prove. The company frames itself here as two very different businesses under one roof, and I think that framing is exactly right. On one side, DS, the components arm, they call it the pickaxe seller, and honestly, I love that. The filing describes it as the AI goldmine, making DRAM, NAND, and HBM for AI chips, plus running the Foundry. The company says this is the ultimate profit engine, minting unprecedented margins as AI sparks severe memory shortages. On the other side, DX, the device arm, the one that sells you a Galaxy phone, a TV, a display. And here management is blunt. They call it the consumer poison, suffering severe margin compression. The exploding cost of internal memory has pushed the mobile business into an operating loss. Think about that for a second. The same chip that's making DS rich is making DX poor. One company, two fates, and the tension between them is the story of this entire quarter. The company did something I wish more of them did. They took the record quarter apart to show you what's real and what's noise. There was a positive kicker first. The filing shows a KRW 3.1 trillion FX tailwind, driven by a stronger dollar lifting component prices. And there was a negative one, a massive one, time H1 performance bonus payout, equivalent to 10.5% of first half accumulated operating profit. Strip both of those out, and here's what the company wants you to see. The core is still historically strong. They call it the signal. A volume and price surge driven entirely by structural memory shortages. After all the adjustment, the final output, KRW 171.5 trillion in revenue at a 52% operating margin. My read, and let's be fair to them here, backing out the FX and the bonus is honest reporting, not spin. The underlying engine really is running hot. The noise just makes it look even louder than it is. Now to the number that made me sit up. The company reported DRAM average selling prices up 40% in a single quarter. NAND up 60% in one quarter. I'm telling you, prices do not move like that in a normal cycle. A jump that violent isn't seasonal, and management says so plainly. This signals a structural deficit, not a fluctuation. So what's driving it? The company points to what they call the agentic AI catalyst. Here's the plain English version. AI is now doing multi-step reasoning, and every step burns memory. That exponential token growth forces AI servers and ordinary compute servers to fight over the same limited pool of chips. Picture the warehouse club on a Sunday, one checkout line, and suddenly twice as many carts. Something's got to give, and it's price. To be fair, the bears will say prices this hot always mean revert, and historically they have been right. Our take on maybe 65%, this one holds longer than usual, precisely because the demand is new, not just restocking. The company lays out three growth engines, and the first is HBM, the high bandwidth memory that sits right next to the AI chip. Let's be honest about the backstory. Samsung fell behind here. A rival got to the AI party first. So this page is the comeback plan. Management projects Q3 HBM4 sales to jump more than 3x quarter on quarter. The HBM4 to capture more than 60% of total HBM revenue in the second half of FY2026. And the company says it delivered the industry's first HBM4E samples to major clients, locking in 2027 supply contracts. The stated goal, get HBM market share back in line with their overall DRAM share by the second half. Here's the honest caveat, and the company's own deck admits it later. Samples are not mass production. Delivering a sample and shipping millions of units at yield are two very different things. So I'm genuinely encouraged here, but I'm keeping this one in the show me column until the volume actually lands. Engine 2 is NAND, the flash storage business, and this is the one that quietly flipped on its head. NAND used to be the margin drag, the part of the portfolio that dragged everybody's mood down. The company says agentic AI and KV cache storage demand turned it into a critical profit center. Look at the mix shift. Server SSD now accounts for more than 60% of the total NAND mix, a jump of over 20 percentage points year on year. That's the whole story right there. They pivoted from selling you a memory card to selling data centers. Management guides QLC bit shipments to more than double in the second half versus the first, pushing into 256 terabyte high-capacity drives. The filing also notes PCI Gen 6 SSDs got positive evaluations from major clients, with next-gen V2V NAND slated for mass production in August 2026. My read, this shift from consumer to enterprise is exactly the kind of change that makes a commodity business less cyclical, and I don't say that lightly. Engine 3 is the Foundry, the contract chip-making arm, and the gauge on this page is pinned near 100%. The company says its advanced nodes, 8nm and below, are fully loaded, running flat out. They report 7nm design wins with major cloud providers and AI HPC clients, and say they're actively negotiating with Broadcom. That last name matters. Landing a Broadcom scale customer would be a real credibility stamp on their most advanced process. Management guides double-digit year-on-year revenue growth in the second half. And they see AI HPC applications climbing from the high teens % of the mix in 2025 to more than 30% in 2026. On capacity, the filing points to Taylor Fab 1 production in 2026, with Fab 2 construction starting year and for 2030 output. Now, to be fair to the skeptics, and the deck admits this too, full utilization does not yet mean profitable. So I like the demand signal a lot, but the Foundry still has to prove it can make money, not just run busy. This page for me is the heart of the whole deck. This is the actual gamble. The company is trying to rewrite its own stock story, from cyclical commodity to predictable visibility. And here's the machinery. 1. 5-year rolling contracts, renegotiated annually with an option to extend another year. 2. And this is the big one, they're committing 60 to 70% of total production capacity exclusively to those long-term contracts. 3. The filing says contracts are fully executed with the world's top 5 data center clients, with 5 more in the final stages. 4. They're enforcing minimum price floors and collecting 25% prepayments upfront, the exact scale protected by an NDA. Think about what a 25% prepayment really means. The customer is putting cash down years ahead. That's not a handshake, that's commitment. Our take, this is genuinely clever. Locking demand is how you kill the bust half of boom and bust. But keep your eyes open. Locking up 60 to 70% also means if spot prices scream higher, they've capped their own upside, and that's the trade. Now, why should we believe the shortage actually lasts? This page is the company's answer, and it's a physical one. Management's argument, even with maximum capex thrown at the problem, meaningful new supply is mathematically impossible before 2028. Why? Building a fab takes more than 3 years. That's concrete and steel and lead times. You simply can't rush it. So here's their timeline. 2026, a severe shortage, and 2027, they project tightness, even more severe than 2026. 2028 is the earliest window for any real supply relief. That's the wall. The company also plays a credibility card, and it's a fair one. They delivered on last quarter's promises, the long-term contracts and the HBM balancing. So they've earned some right to dictate this timeline. Here's my honest position. The physics argument is the strongest part of this whole bull case. You can't wish a fab into existence. I'm maybe 70% that the shortage runs into 2027, but any forecast 3 years out deserves humility, and I'll happily be corrected. This page is basically the company doing our job for us, laying management's claims right next to a skeptic's translation. Claim 1, the shortage is locked until 2028. The honest translation, that story supports a long-term valuation, but dragging the shortage out also maximizes the cost damage to their own phone unit. They're stuck cheering for the very thing that hurts half their own company. Claim 2, a stable, de-risked model built on long-term contracts and prepayments. And if it's true, that's a genuine valuation shift. But, as the deck itself admits, locking 60 to 70% of capacity deliberately caps the upside if spot prices keep surging. Claim 3, first to sample HBM4E, massive volume ramp imminent, and sure, that's crucial for catching up. But sending samples is not mass deployment, and execution stays an unverified forecast until the units actually ship. I'll give the company real credit here. A deck that argues against itself like this is more trustworthy, not less, and that earns points from me. Remember the 2 Samsungs. This page shows you exactly how they collide, and it's uncomfortable to watch. It's a loop. DS jacks up component prices. That feeds straight into MX cost inflation, and corporate margin is what drips out the bottom. Here's the hard number. The company reported the MX and Networks division generated KR 32.3 trillion in Q2 revenue and still swung to an operating loss of KR 0.7 trillion. Read that again, 32 trillion in sales, and it lost money. The cause, per the filing, their own DS division's price hikes are inflating the bill of materials for Galaxy phones. The Band-Aid management is forced to suppress second-half mobile shipments leaning on flagship models, the S26, the Z8, the S26 FE, plus A-series upsells to defend revenue. And it's not just phones. The deck says the panel division faces a similar squeeze from new Gen 8.6 fixed costs. My take, this is the single biggest crack in the whole story. The profit engine is actively eating its own sibling. This is the page I'd pin to the wall. 4 risks the company itself is flagging, plus how the analysts reacted on the call. Risk 1, memory expectations. At a 52% operating margin, the baseline is punishingly high, and the company warns any ASP deceleration will trigger a violent market overreaction. On sentiment, the deck notes analysts questioned this 4 separate times, and management answered with concrete metrics, so high confidence there. Risk 2, Foundry, still not profitable despite full utilization. And here's the tell, management deflected 3 direct questions, citing only near-term profitability with no firm dates. VAG is a yellow flag and I'm marking it. Risk 3, mobile already underwater, and a long shortage guarantees prolonged bleeding in consumer hardware. Risk 4, capital. Management firmly denied any immediate plans for a US listing and ADR, sticking to the current 3-year return policy. My red, watch that Foundry deflection closest. When management gets specific on the good stuff and fuzzy on the hard stuff, that gap tells you where the real risk lies. Here's where the company makes its pitch to investors, and it's really a pitch about how you should price the stock. The old way, treat Samsung as a cyclical boom and bust, driven by consumer demand, and slap a low cyclical multiple on it. The new way they're selling, a visibility premium, driven by a locked-in AI backlog. The thesis, if that 2027 and 2028 shortage holds, the duration of this upcycle will shatter historical precedent. But the company is honest about the prerequisites, and this is the fair part. 2 things have to be true. 1, agentic AI compute demand can't decelerate, and 2, those long-term contracts and prepayments have to actually absorb market shocks. The implication they want, stop valuing this on a cyclical chip, PKE, and start valuing it on long-term visibility. Our take, the bulls would say this rating is worth a lot of upside, and honestly, they're not wrong if it works. But an investor betting on this is really betting on both prerequisites at once, and I'd size that position accordingly. If you take one practical thing from this whole deck, make it this page, the 6 things to actually watch. 1, HBM4 execution. Did the Q3 sales really jump more than 30x? Did H2 revenue share clear 60%? And is HBM4E hitting mass production? 2, ASP trajectory. Watch DRAM and NAND pricing. The company calls it the real-time thermometer of the shortage, and that's exactly right. 3, contract coverage. Confirm that 60 to 70% capacity lock is holding, and watch whether the 25% prepayment pool expands. 4, MX recovery. Mark the exact quarter the phone division stops bleeding and gets back to profit. That's the one I care about most. 5, Foundry milestone. Watch for advanced node revenue clearing 50% and a real pivot to operating profit, not just busy fabs. 6, capital allocation. Watch the shareholder return policy and any softening on that ADR stance. My take, print these 6 out. This is your scorecard for whether the de-cyclicalization story is real or just a very good slide. Alright, let's bring it home. The company's own final takeaway is refreshingly blunt. The record financials, they say, are almost a distraction, and the true valuation hinges entirely on 3 things. The 5-year rolling contracts, the massive prepayments, and that 2028 shortage forecast. If management wins, the deck says the valuation logic rewrites itself into a high visibility backlog premium. If it loses, whether from an AI demand stall or the DX division collapsing under its own costs, the company stays exactly what it's always been, a giant slave to the boom and bust cycle. That's the fork and everything rides on it. Alright, last thing, radar always leaves you a light. I'm calling this one yellow. The business is flat out impressive, and this de-cyclicalization plan is the smartest thing this company has tried in years. But the mobile division is bleeding today, the Foundry still isn't profitable, and the whole re-rating rides on a 3-year forecast. If they hold that shortage into 2027 and the phone unit stops bleeding, I flip to green, and I'm telling you that up front. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.